Today, we're digging into the Federal Reserve's latest move, or lack thereof, on interest rates.
Right, they decided to hold steady again. We'll break down what that means.
We'll look at the official reasoning, the impact on, well, everything from your car loan to your savings, the job market, and this whole tariff situation.
It's a complex picture right now.
Definitely. And if you want to keep up with analyses like this, make sure to like and subscribe. It really helps us out.
Absolutely.
So the big news first. On May 7th, the FOMC kept the federal funds rate target where it was.
Yep, still in that 4.25% to 4.5% range.
And their statement sounded cautiously optimistic. Solid growth, low unemployment.
Exactly. They see the labor market as still solid economic activity expanding. But
there's always a but.
Well, yeah, inflation is still, quote, somewhat elevated. And they specifically mentioned that uncertainty about the outlook has increased further.
So they're worried about risks on both sides, like unemployment going up and inflation staying high.
That seems to be the assessment. They said the risks for both have risen. So they're watching the data very, very carefully.
They're still shrinking their balance sheet too, right? Selling off those treasury securities and mortgage-backed securities.
Correct. That process is continuing as planned. No changes there.
Okay, let's talk impact. When the Fed holds rates like this, what does it mean for borrowing costs generally?
Generally, things stay put for a bit, but the cumulative effect of past hikes is still very much being felt. Rates on things like auto loans, credit cards, HELOCs, they tend to track the Fed's rate pretty closely over time.
And we've seen huge jumps since the pandemic era, haven't we?
Oh, absolutely. Just looking at the numbers up to, say, the end of April 2025, a $30,000 HELOC, up 3.7 percentage points. It went from around 4.24% to nearly 8%.
Wow.
Home equity loans, similar story, up about 3 percentage points from roughly 5.3% to over 8.3%.
And credit cards, those always seem high.
Even higher now, up almost 4 percentage points. The average rate moved from just over 16% to above 20%.
Ouch. What about car loans?
Used car loans, the 4-year ones, saw about a 2.85-point increase from 4.8% to 7.65%. And new car loans for 5 years went up even more, about 3.15 points, from just over 4% to nearly 7.33%.
So borrowing is significantly more expensive across the board, but mortgages are a bit different, you mentioned.
Right. The classic 30-year fixed mortgage doesn't track the Fed funds rate directly. It's more closely tied to the 10-year Treasury yield.
And that's influenced by inflation expectations and general economic growth outlook.
Exactly, which is why mortgage rates have been on such a roller coaster. Remember early 2021? We saw rates below 3%.
Feels like a lifetime ago.
Doesn't it? Then they peaked way up at over 8% in late 2023. As of late April this year, they were hovering around 6.8%. Still high historically, but off that peak.
Okay. What about the other side of the coin, savings? Savers were finally getting some decent returns.
They were, and yields are still relatively high compared to a few years ago. Savings accounts and CDs generally do move with the Fed funds rate.
But have they maybe peaked?
It looks that way, at least for now. The highest yielding 5-year CD, for instance, is around 4.15%. That's down from a peak of about 4.85%.
And shorter terms, like a 1-year CD.
Similar trend. The best 1-year CDs are maybe offering 4.4%, but they peaked higher, closer to 5.75%.
And high yield savings accounts.
Those are around 4.5% now at the top end, down from peaks around 5.55%. Still way better than the national average.
Which is still incredibly low, right?
Yeah, the national average savings yield is something like 0.47%. So the difference between that and what you can get, especially at online banks, is huge. Really pays to shop around.
Definitely. Now, beyond just the cost, do higher rates make it harder to even get a loan?
Yes, that's a significant factor. When rates are higher, lenders worry more about borrowers potentially defaulting. So they tend to tighten their lending standards.
They become pickier.
Exactly. More selective. It just gets tougher to qualify for new credit, whether it's a mortgage, a business loan, or even a credit card sometimes.
Is there data on that? Are more people getting denied?
There is. Looking at the period between roughly December 2023 and December 2024, almost half, 48% of people who applied for some kind of loan or financial product were denied.
Nearly half. That's striking.
It really underscores how much credit conditions have tightened up in this higher rate environment.
Okay, let's shift gears to the stock market. How does the Fed's stance typically play out there?
Well, higher interest rates can make safer investments like bonds and CDs look more attractive compared to stocks. Why take the risk in equities if you can get a decent guaranteed return elsewhere?
So money might flow out of stocks?
Potentially, yes. Also, there's always always the fear that the Fed might overdo it with rate hikes, pushing the economy into a recession. That's almost always bad news for stock prices.
But the flip side is true too, right? Lower rates can boost stocks.
Generally, yes. Lower rates make borrowing cheaper for companies, can stimulate growth, and make investors more willing to take risks. But, it's never just about the Fed.
Right. Other things are always going on, like trade policy uncertainty, for example.
Exactly. Geopolitics, company earnings, inflation itself. Lots of factors drive the market day to day.
Let's talk about inflation and purchasing power directly. How do interest rates affect how far our money goes?
Well, the theory behind low rates is to encourage borrowing and spending, boosting demand. But if supply can't keep up, that increased demand can just lead to higher prices, inflation, which erodes your purchasing power.
And high rates are meant to do the opposite.
Correct. By making borrowing more expensive, the Fed hopes to cool down spending by both consumers and businesses. Less demand should, theoretically, ease pressure on prices.
But there's a downside to cooling the economy too much.
Absolutely. If the economy slows down significantly because of high rates, businesses might cut jobs. And losing your job obviously decimates your purchasing power, regardless of what inflation is doing. It's a tough balancing act.
Which brings us to the job market. You mentioned it's cooling.
It seems that way. Higher rates can make businesses pause expansion plans or investments because the financing is more costly. That can lead to slower hiring or even layoffs.
What are the numbers telling us?
The national unemployment rate has been stubbornly above 4% since May of 2024. It's currently sitting at 4.2%.
Still historically low, but creeping up.
Right. And the pace of job creation has definitely slowed compared to the boom years after the pandemic reopening. We've also seen some high-profile layoffs, especially in the tech sector.
And there's other uncertainty too.
Yeah, things like potential federal government layoffs depending on budget decisions, and also the economic effects of these proposed tariffs. That adds another layer of uncertainty for businesses thinking about hiring or expanding.
Let's talk about those tariffs. President Trump's proposals seem to be a major wild card. How is the Fed viewing this?
Very carefully, you can be sure. Tariffs present a really tricky problem because they could push up inflation by making imported goods more expensive.
While also potentially slowing down economic growth if they disrupt trade and investment.
Exactly. That's the dreaded stagflation scenario of stagnant growth plus inflation. It makes the Fed's job incredibly difficult.
Because their tools work best against one or the other, not really both at the same time.
Precisely. Raising rates fights inflation, but could worsen a slowdown. Cutting rates might help growth, but could fuel inflation. It's a classic policy dilemma.
Has Chair Powell commented on this?
He has acknowledged the uncertainty that trade policy, specifically tariffs, introduces into the economic outlook. And most economists seem to agree tariffs are likely to mean higher prices for consumers down the line.
So despite the Fed holding rates now, the market seems to think cuts are coming later this year.
That's generally the expectation, yes. Financial markets are pricing in future moves.
What are they getting on?
Well, looking at futures markets, traders see a pretty high probability of the first rate cut happening by the July FOMC meeting.
That soon?
That's what the market is currently implying. And some big players, like Goldman Sachs analysts, are projecting cuts not just in July, but maybe also in September and October.
But that's just a forecast, obviously.
Absolutely critical to remember that. The Fed keeps saying they are data dependent. So the actual timing and number of cuts, if any, will depend entirely on what happens with inflation and employment data in the coming months.
And Powell's press conferences after these FOMC meetings are always key moments, aren't they?
Hugely important. Markets hang on his every word, trying to read between the lines for clues about future policy.
What will people be listening for specifically?
His assessment of inflation trends, his outlook for economic growth, any nuances in how he talks about the labor market, and definitely any further comments on how the Fed is thinking about those potential tariffs and their impact.
The tone matters as much as the substance sometimes.
Very much so. A slight shift in language, whether it sounds more worried about inflation, hawkish, or more concerned about growth, dovish, can move markets instantly.
Okay, one last area, just briefly. Does any of this Fed talk impact something like cryptocurrency?
It can, yeah. Crypto is generally seen as a risk asset, similar in some ways to tech stocks.
So if the Fed sounds like it might cut rates soon, a dovish tone that could be good for Bitcoin.
That's the general thinking. Lower interest rates can make riskier investments seem more appealing. Conversely, if Powell sounds really tough on inflation, emphasizing restrictive policy, a hawkish tone that could put downward pressure on crypto prices.
So crypto markets were also paying close attention to Powell's recent comments.
Definitely. Like many other markets, they were waiting to see which way the wind was blowing from the Fed.
So wrapping up, the Fed is holding steady for now, but it's navigating a really complex environment.
That's the key takeaway. They're balancing still elevated inflation against a solid but perhaps slowing labor market, all while facing this new uncertainty from proposed tariffs.
And these decisions have real-world consequences for everyone, impacting your borrowing costs, how much your savings earn, maybe even job security.
Absolutely. The economic picture is still evolving, and what the Fed does next will be crucial for individual finances and the economy overall. It really pays to stay informed.
We hope this discussion helped make sense of the latest developments. Thank you for tuning in.
Thanks for listening.
And if you found this analysis helpful, please do like and subscribe. It helps us bring you more content like this.